the inverted yield curve reached almost 50 basis points. That's the biggest inversion we've seen in the last 40 years. That's a deeply inverted yield curve, and that always is a sign to get out of harm's way. A recession is coming.
Please join us for our next live stream Monday, August 21st at 9 p.m. Eastern. We'll go over current events, past guests, and of course, gold and silver news. Once again, our next live stream will be p.m. Eastern. See you then. Hello again, everyone, and welcome to another edition of Silver Bullion Television, SBTV. I'm your host, Patrick Vieira. Michael Pento, president and founder of Pento Portfolio Strategies, joins us today. With more than 30 years of professional investment experience, Michael has also worked on the floor of the New York Stock Exchange during the mid-90s. And he has also served as an economist for both Delta Global and Euro Pacific Capital. And he was also the portfolio creator and consultant to Delta Claymore's commodity portfolios, which were distributed through Claymore Guggenheim sales networks. And we're delighted to have Michael join us once again here today. It's time to saddle up and silver up for Michael Pento. Michael, welcome back to SBTV. How are you doing?
Great to see you, Patrick, as always.
Glad to have you back. You know, Michael, I want to start with getting your comments on a few recent items. One, the Inflation Reduction Act, which was recently passed. It was designed to combat climate change, address healthcare costs, and raise taxes on large corporations. And policymakers say this act will also reduce the price of electricity, cars, appliances, and the deficit going down some $300 billion, which reduces pressure on interest rates. What's your take on how these things reduce inflation per title of the Inflation Reduction Act?
Well, isn't that the way it always works, Patrick? The government spends money and inflation goes down. Isn't that the way? This is, I guess, a regurgitation of the Build Back Better plan, although severely attenuated. I think it's like $400 million over 10 years. And it's not just that the government's going to be spending money and the Fed's going to be printing it. It's quite the opposite. The government's going to be spending money and raising taxes. The 15% minimum corporate tax, 1% tax on buybacks. So, and by the way, hiring an army, 100,000 or 80,000 IRS agents to come take more of your money is, I just don't see any growth in this or any inflation reduction in this. Inflation is coming down. It's going to come down. I think it's going to come down maybe even sharper than most people believe, simply because, listen, most of the fiscal spending is behind us. We had $6 trillion worth of that. But all of the monetary largesse is gone. Instead of printing $4.5 trillion, the Fed is, and this is what Powell said in his press conference, and not many people are talking about it. I'm the only person that I know of as actually making news about this, or at least promulgating what he said. Not news, but promulgating what he said. He said he was going to reduce the balance sheet by $95 billion. Everybody knows that. Starting in September. Everybody knows that. But what they are not talking about is that Powell is going to be doing that pace of quantitative tightening or monetary destruction for, according to him, out of his own mouth, according to him, 2 to 2.5 years of destroying the monetary base by north of $1 trillion each of those years. I mean, that's monetary destruction on steroids in conjunction with the Fed raising interest rates. So that's deflationary. That's disinflationary first, which we saw in the CPI and PPI prints. And you're going to see deflation in asset prices. We saw deflation in stock prices. Then we had a July bounce. You'll see, I think, in the fall and the winter, a much steeper decline in stock prices. You'll see a fall in home prices begin. And of course, you already saw the fall in bond prices.
Okay, a couple pretty interesting things there. I mean, we went through a bout of defunding the police, and instead we're funding the IRS to get agents to police us.
Isn't that what the average person wants, Patrick? They want more IRS agents. That's wonderful. You know, I don't have a cash business. Everything I make is reported to the to the appropriate authority. So, but government more government intrusion into your life, taking money from people who produce things. And even if they, even by the way, they're looking for people who are stealing money from the government. What if they're not? They have to go back through, instead of being productive and hiring people and expanding their business, they have to prove to the IRS that they're actually not taking money from the IRS, withholding money from the government. It's a drain on productivity, and that's a drain on economic growth. We don't need more IRS agents. We need more productivity. And by the way, productivity plunged in the second quarter. So we need immigration, we need population growth, we need labor force growth, and we need productivity growth. We don't need growth in government.
Yeah, I mean that's another great point where the productivity plunged because this Inflation Reduction Act. I mean, considering what it's going to do, where taxes on large corporations. I mean, we've seen this before, where when these things happens, corporations tend to leave the U.S. and do business outside of the U.S. Do you kind of see this coming on again?
Well, I mean, I would normally say yes, but I mean, are things much better off in Europe right now? In China, where you can't, are they going to go to China, where if someone sneezes, they lock down Shanghai and Beijing? I mean, yeah, corporations are probably not going to leave en masse out of the United States. But what they will do, as I said, is become less productive when they need to increase productivity, because what brings down inflation? Sound monetary policies, sound fiscal policies, and an increase in productivity. Lower taxes, lower interest rates, lower inflation. That's all that's a magic elixir for the market. Less regulation. This is the exact opposite of what's going on right now.
And also the current administration. I mean, recently they looked at redefining what a recession is, trying to tell us that all is well. I mean, how do investors navigate through these types of narratives?
Well, you listen to these people, Powell, Yellen, uh, Biden. You listen to these people on mute, because that's when they make the most sense, if you have to listen to them at all. Listen, you can redefine it any way you want. You could say that the economy is booming, we're not in a recession. You could say we're not in a bear market. It doesn't matter. This is what you have to understand when you invest. What's the second derivative, the rate of change of the rate of change in growth and inflation? Well, both those things have peaked and are rolling over. And here's what I want to impress. If there's one thing I can impress upon you and your audience, get ready for this. It is not bullish when inflation and interest rates peak. That is not bullish on its own. That would be bullish if growth was accelerating as inflation was coming down. What's happening is, during July and so far in August, the market now believes in a soft landing, the soft landing fiction, where inflation's coming down, but growth is going to magically accelerate. That is baloney. I mean, I can't be sure. Only God knows. I'm not, and obviously, not fit to untie the sandals of John the Baptist, let alone Jesus. So I'm not God by any, and not even an angel. I am just a human being. But I can tell you this: my math, my model, my money is on a greatly falling second derivative of growth in this country and around the world. China's manufacturing sector is in a recession. Japan is in a recession. The UK and the Eurozone is heading into a deep recession. The United States is in a recession if you look at two contracting back-to-back quarters of negative growth. And even if we come out of a recession, a truncated period of time in Q3, we're going to head right back into a deep dive in Q4. So there's no growth anywhere to be found in the whole world. 80 plus of the global central banks around the world are raising interest rates right now at this juncture. And let's just look at what's happening. We've had a recession. We have very slow growth in Q3, recession in the first half of this year. The Fed started hiking rates in March of 2022. They went from 0 to 2.3% on the effective Fed funds rate. So over the last 5 months, the Fed has started from 0 and brought the overnight interbank lending rate to 2.3%. So almost none of the negative effects of higher borrowing costs, almost none of a higher prime lending rate, overnight interbank lending rate, are in the market right now, and in the economy. Very little of it has actually started to affect the economy. Almost none of the quantitative tightening has yet begun to bite because it hasn't really even begun yet. The Fed's balance sheet topped out at almost $9 trillion and declined to 8.91 or something like that. So we have very, like 900 billion maybe of QT. That's nothing. I'm sorry, 90 billion, right? Of QT. Almost nothing yet has happened. But we're going to do that every month now for the next 2 to 2.5 years, according to Powell. So that's also very deflationary and destructionary to economic growth. We also have a Fed that's going to raise interest rates from 2.3%, as they are today, all the way to 3.3 by the end of this year. That's what they tell us that's going to happen. So you get 50 basis points in September, and you get another 25 in November and December. Now, in that context of a slowing global growth, you have one of the most hawkish central banks ever. And that dynamic is happening just as we see one of the most expensive stock markets ever. 170%, the total market cap of equities is back to 170% of GDP. That figure was in the dot bomb bubble. That figure was 140%. So we're way over our skis as far as what the valuation of equities should be. And even in the global financial crisis, we saw that figure about 104%, 103, 104% of GDP. So we have one of the most overvalued stock markets ever in the context of slowing growth and a very, very hawkish complex of global central bankers.
If you're enjoying this interview with Michael Pento and I, please consider subscribing to our YouTube channel to let the algos know you want to see more content like this. And if you'd like to learn more about systemic wealth protection, please visit us at www.silverbullion.com.sg. Okay, two questions here with what you were saying. So soft landing is pretty much out of the question. And how high do you think the Fed can actually get raising rates?
Oh, well, I think they will get to 3 point. I think they will continue on till the end of this year, and sometime between the winter, late fall, winter, spring. So figure Q4 to Q1 of 23, Q4 22, Q1 of 23. Sometime in the best of my ability, my time frame is that's when the QT plus rate hikes freezes the credit markets and the Fed has to stop. The last time interest rates were this high was in September of 2018. So the Fed funds rate went to 2.25% in September of 2018. Patrick, do you know what happened in September of 2018 to the end of the year?
The wheels fell off.
The S&P dropped 20% and the Russell 2000 lost 30%. The market is more expensive today than it was back then. Oh, by the way, economic growth was 3%. 3% GDP back then. Today it's 0. So the reason why the wheels fell off the economy, as you so appropriately put, back then, is because the market could not withstand an interest rate, given the leverage, debt, margin debt, all the debt in the system. They just couldn't. The economy could not withstand 2.25%, unbelievably, but that's how overextended we are. Couldn't take 2.25%. Well, now we have more leverage, more debt, more expensive stock market. The total debt in the system, by the way, right now, it's high as the all-time record back in December of 2007, which was the start of the global financial crisis, 345% of GDP. So nothing's guaranteed, but the odds are really against you to chase a bubble a bear market bounce right now, heading into that dynamic where you see, well, the history has shown us before when the Fed funds rate reaches this level, as it did in September of 2018, things tend to break. By the way, the Fed stopped hiking rates. They promised to stop hiking rates in December, and we had a market rally. Market rallied all the way, not until COVID. Market rallied again for another about 6 months, another bear market bounce. Rallied all the way to what? The fall of 2019. You know what happened in the fall of 2019? Guess what happened? The repo market froze. Remember that? The repo market froze. And so the Fed continued on with quantitative tightening, but stopped hiking rates. So maybe something similar to that is going to happen, where the Fed stops tightening interest rates. We get a brief rally, and then we do quantitative tightening twice the pace as we did in the last round of QT, and then something breaks down the road. I'm here every day. I monitor these dynamics. So, the best thing you can do right now is to stay defensive, stay cautious. I think phase 2 of this market debacle is going to be one where bonds rally. So bond prices go up, yields come down. And that happens in conjunction with disinflation, deflation, and rapidly slowing growth. So everybody who's hiding out in tech, everybody who thinks that the NASDAQ is somehow the NASDAQ, the NASDAQ's a great place to hide. And, the Reddit stocks that people are, the Reddit board stocks, that's a great place to hide out in a recession. You might want to rethink that. Well, you have time.
Another interesting point, you said that you're looking at a bond rally where the yields come back down, and right now we're seeing yields inverted. So you say they're going to kind of go back to normal again?
The inverted yield curve reached almost 50 basis points 2 days ago. That's the biggest inversion we've seen in the last 40 years. So the yield curve is saying the same thing it's been saying. Now it's like 37 or 38 basis points, but it's not 3 basis points or 10 basis. That's a deeply inverted yield curve. And that always is a sign to get out of harm's way. A recession is coming. And a recession that starts when the market's at 170% of market cap to GDP, when price to sales are at an all-time record high, median PE ratios at an all-time high, really dangerous time to be long the stock market without any hedges. So I'm about, listen, I try to make money in bull markets, try to make money in bear markets. But the most important thing is not to be down. If you're down 20%, you need 25% to get even. Down 50%, you need 100% to get even. Don't do that to yourself again, because that's probably what's going to happen. So being down a couple of percentage points and getting prepared for the next bull market run, which I think there's going to be a big bull market in gold coming up in the stagflationary environment that I foresee in the future. There are plenty of ways you can make money after this bear market ends. But going levered long on tech stocks now is really dangerous.
You mentioned the word disinflation, and now we hear stagflation. I mean, if you could give us your best guess, we have inflation right now, and then what follows inflation, and then what follows after what followed inflation?
So we had the highest inflation we have ever seen in this country. If you measured it with the same mechanics used pre-Boskin Commission, so we're talking about close to 20% inflation. It's ridiculous. So what does disinflation mean? Let's define it. Disinflation is a lower rate of inflation as compared to the prior measure. So it's just the rate of change or second derivative. So if inflation went from 9.1% to 8.5%, that's disinflation. That doesn't mean, Patrick, that you can go to your grocery store and start paying the same prices you had pre-pandemic. That's not what that means. It just means that the rate of change of price increases are slowing, but they're still going higher. The rate of change on your house, which your new home purchase that no one can afford any longer, it's not coming down yet. It will. Hopefully, it will. God willing, it will, because you need a healthy housing market for a healthy economy. But who can afford a down payment anymore? I mean, if you're in the 1%ers like you and I probably. that's not a problem. But if you're not, if you're the average person, by the way, 40%, 4 in 10 Americans say they have trouble paying their bills. Many of these people are renters, Patrick. Try and tell these people that they have to come up with, $80,000 down payment just to meet the 20% minimum. So of a new home purchase. So we have to get disinflation. I think there will be outright deflation in parts of the economy, but especially in asset prices, deflation. And then then the question is this, and I don't have a good answer for you yet. I don't know. I have to guess the answer, because the reaction function of the Fed is hard to determine that far out. Right now, it's easy to determine. The Fed is hiking rates into a recession. They're going to blow something up, mostly the credit markets, commercial paper, repo, junk bonds, the shadow banking system. So what do? Here's the problem. They blow something up, and then they go back into QE and ZIRP right away. Let's assume that's what they would do. That's a really dangerous thing for the Fed to do. I think they'll be very reticent and very reluctant to do that, because the sting of 9.1% inflation is fresh in their mind. I mean, they know what's going to happen. If Janet Yellen comes out with a massive stimulus package, assuming it gets through Congress, which it probably won't, because the Democrats will lose the House in the midterms. If that happens, they're not going to be able to come with a massive stimulus package. And it's, if it's monetized by the Fed, let's just say they were able to do that. If that's monetized by the Fed, you're going to have stagflation as far as the eye can see. And they don't want that. So I think the Fed's reaction function is going to be a lot slower to commence.
How do you think gold is going to be doing during this period of as inflation starts to taper off with disinflation, and then even if it goes into a deflationary period?
So gold is not like it's when you have a liquidity crisis, which I see coming. It's not happening yet. We're so clearly not in that position yet. But gold will suffer because people sell what they can to raise money. They need dollars, so they sell what they can, and in many cases that's gold, precious metals. But that's usually a very truncated problem, because on the other end of that, as I said, the Fed might opt to go back into QT and ZIRP in conjunction with some kind of stimulus package. I have to see what they do. If that's the case, then you're going to have a cap on interest rates, because the Fed will be printing money, creating inflation, and putting a cap on interest rates. When that happens, Patrick, what's the function? So nominal rates are capped, and inflation goes higher. That's a fall, otherwise known as, AKA, a fall in real interest rates. And that is always rocket fuel for gold. And that would happen in conjunction with the dollar cratering. So if that's indeed the reaction function of the Powell-led Fed, then you can't have enough gold in your portfolio. Again, I don't think that's going to happen right away. I think they'll get there, but they'll get there more slowly. In other words, the Fed put is further away in time and lower in price. So if you can time your gold purchases, a little more accurately. I mean, thank goodness we were out of most of our gold in earlier this year for the big cascade in both the metal and especially the miners. That's all going to reverse once the Fed turns around and acquiesces to, hey, listen, we can't raise interest rates. We're going to have to go back into stimulating the economy, and that should be rocket fuel for gold.
I just want to get back to the bond situation here. We're seeing this yield inversion right now happening, but I want to go back to 2007. Is the inversion happening right now? How does it compare to 2007, 2008?
It's much deeper than that. So right now, at a 40 basis point inversion, that's where we were in 1999. And then if you want to go deeper than that, you have to go into the 80s, to 1980, where it was inverted by over 100 basis points. So we're not there, but you don't have to be that inverted to have a recession. We already had a recession. The yield curve first inverted many months ago, and everybody said, "Oh, don't worry about it. So it's meaningless now. It's mechanics because blah 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 blah." it's malarkey. Now they're saying the yield curve is inverted, but it doesn't matter because it only inverted for like a week or two. No, it's not just it's all noise and distractions. An inverted yield curve is not only a signal of a recession, it's a signal that the banking system isn't functioning properly. So when you think about an inverted yield curve, banks, they borrow short, they lend long. Well, if the money that they're borrowing is more expensive than the money they're lending, they tend not to do that. Now I have to tell you, I have to put this out there. I have a lot of money in a bank. I won't name the bank, but my interest rate that they're giving me on that money that's parked there is 0.05%. So so the banks can make money, but it doesn't make a difference. The main functionality here is that an inverted yield curve is saying that inflation in the out years, longer in duration in time, on the x-axis is going to be much lower than it is now. So what the market is telling you very plainly is that we are going into a recession and asset prices are falling. And when asset prices fall, I mean, if you have a housing debacle, which I think is going to happen, not going to be as bad as the global financial crisis. Maybe home prices drop 10, 20. I think 20% would be a good number to put on it. When that happens, banks tend to stop lending money. The Blackstones of the world tend to stop buying huge tracts of land when their asset prices are going down. They tend to buy them when they're going up so they can rent it out. Their rents go higher, the principal appreciates on the balance sheet, they've got great cash flow. And the opposite is, when people are stop paying their mortgages and their prices are going down, it inverts the balance sheet.
Okay, so you think that's in the cards coming down the road where we're going to see mortgage crisis again coming down?
I think you're going to have a lot of people who own a home, especially in the places where it went up 80% in the last year or two, are going to be underwater on their mortgages and will stop paying them. It doesn't matter if you have, if your home price is plunging and you have no more equity in your home, you stop paying your mortgage, and that very easily could happen again.
Okay, and at that point, you see perhaps liquidity start to dry up.
Correct.
Michael Pento, before we wrap up, can you let the listeners know how they can follow you and how they can learn more about your work and contact you?
So the website is pentoport.com. My email address is mpento@pentoport.com. The office number is 732-772-9500. I have a midweek reality check podcast I put out every Wednesday. You can get that for a free trial of 5 weeks. And it's $50 if you want to per annum, if you'd like to have it. Gives you some really unique and concise thoughts about the dynamics in the market that you really need to know if you want to be a successful investor. And if you have $100,000 and you're a U.S. citizen, then I will personally manage the money for you. So 1.5% or less annual fees and no performance fees. So you get I manage the money like a hedge fund, but one that knows what it's doing and doesn't steal all your money from you when you're successful. Steal. They take 2 and 20, 2% on assets under management, and 20% of your return is a really bad deal for the customer. And the customer always has to come first.
Absolutely. Michael, I want to wish you all the best. Thank you for joining us and helping the viewers make some sense of what's going on. And I hope we can do this again soon.
I hope I was of some help, and it's always great to see you, Patrick. God bless.
That was Michael Pento sharing his views on the economy and what he sees ahead. For more of Michael's work, please visit pentoport.com. If you like this video, please consider subscribing, giving us a thumbs up, and sharing this video with your friends to let the algos know you'd like to see more content like this. Audio-only versions of this interview can be found on iTunes and Spotify.